From Dubai, I am joined by Bhavik Mehta, joining me from Century Financial, Chief Market Analyst. Welcome to the show. There
Okay.
are clear successive warnings about those countries and emerging markets to ability to meet their liabilities and debts and repay them. And it's clear also in the impact on the credit rating of those countries whose debts have been in the junk bonds category. So, to what extent we can say that the framework developed by G20, about which IMF spoke and the World Bank spoke during the recent IMF World Bank meetings 2 weeks ago, they talked about restructuring and a mechanism for that. To what extent this is possible in the short to medium term, or is it just recommendation?
Right.
Go ahead,
To
sir.
yeah, to start with, what has happened in the past is most of these nations, the emerging market nations, so whether you talk about Turkey, Egypt, or even some South American country, these are the nations who have already suffered a chronic problem of high inflation, high debts, as well as traditional big dollar-based debt liability. So at one point of time, a country like Turkey had a debt to GDP ratio of 150%. Egypt is fast approaching about the 100% mark. So what has happened is the G20 resolution tries to basically give out different subsidy packages through the World Bank and the IMF so as to advise these governments that are in debt problem as to how they can service them. But again, I mean, if you look at the global economy, we've got developed markets, we've got emerging markets. As of last year end, that is December 2022 end, the total debt in the 30 highest countries, which have the most amount of middle income to low income population, the entire debt load stood at something like $98 trillion as of 2022 end, which was actually an increase of about 15 to $20 trillion over the last 3 years, ever since the COVID pandemic wave started. Compare this with developed market debt, the numbers have overall gone down by 6 to 7% over the last 2 3 years. So the average experience, to answer your question, the average experience of the developed market investors when they invest in troubled nations, the recovery rate has been something in the range of 40 to 50%. So on an investment of $1, you just get something like 40 cents to 50 cents. So the resolution process is still, I would say, very confusing. It is subject to a lot of political considerations in the host country where the actual debt problem is there.
But also, apart from the investments of those creditors, there was talk about some countries being exempted, just some countries in Asia and Africa indebted to China. China refused to be the one alone having to bear those and asked other major countries to take part through the restructuring, and this is what was causing the dispute regarding the repayment of the debt. So, can we hear about a mechanism to restructure those debt, just like the World Bank was saying?
The message coming out from China has been very loud and clear, specifically the signals that China is sending over the last 1 year. So far, they have been bankrolling nations like Sri Lanka, African nations like Kenya, Nairobi, or even the some amount of inventions that are there in Sudan. But what is currently happening is the entire onus is being put in the hands of IMF and World Bank. So China is very clear. If the country has been bankrolled by China till this point of time, the country actually needs to come up with a credible solution that is being proposed by the World Bank and the IMF. So it doesn't seem to be a lender of last resort in the current scenario.
Bhavik Mehta, thank you so much for
Thank
having
you.
joined us from Century Financial.